Hello, today I will be discussing 15 steps to identify stocks that have the potential to provide long-term growth and income. Watch to the end for a bonus on diversification. Please like, share, and subscribe to learn more. Let me know your thoughts in the comment section. By following these 15 steps, you can identify stocks that have the potential to provide long-term growth and income. However, it's important to remember that investing in stocks comes with risks, and you should never invest more than you can afford to lose. It's also essential to have a diversified portfolio that includes a mix of stocks, bonds, and other investments to help manage risk. 1. Understand your investment goals. It's important to understand your investment goals before you start investing in stocks. Are you looking to grow your wealth over the long term or earn a steady stream of income? Are you investing for a specific financial goal, like buying a house or funding your child's education? Knowing your goals will help you choose the right stocks for your portfolio. 2. Research different industries. Start by researching different industries to find potential investment opportunities. Look at the performance of different industries over the past few years and consider which industries are likely to grow in the future. Some industries that are popular with investors include technology, healthcare, and finance. 3. Follow market trends. Pay attention to what's happening in the stock market to identify potential opportunities. You can do this by following the financial news, reading market reports, and looking at key market indices like the S&P 500 and the Dow Jones Industrial Average. By understanding market trends, you can identify companies likely to perform well in the current market environment. 4. Assess the company's financial health. To determine whether a company is a good investment, you need to look at its financial health. This includes things like the company's revenue, earnings, and cash flow. Look at the company's financial statements, including its balance sheet, income statement, and cash flow statement, to get a complete picture of its financial health. 5. Analyze earnings reports. Earnings reports are important because they give you an idea of how the company is doing financially. Look at things like revenue growth, earnings growth, and any trends that may impact the company's future performance. You can find earnings reports on the company's website or financial news websites. 6. Look at valuation metrics. Valuation metrics are used to determine whether a company's stock is overvalued or undervalued. Key metrics to look at include the price-to-earnings ratio, P/E, price-to-sales ratio, P/S, and price-to-book ratio, P/B. These metrics can help you identify companies that are trading at a discount to their peers or are overpriced. 7. Evaluate the company's management team. The management team is responsible for running the company, so it's important to assess their track record and experience. Look at the CEO's tenure, the company's history of executive turnover, and any controversies or legal issues involving the company's leadership. A strong management team can help ensure the company's long-term success. 8. Research the company's competitive landscape. Understanding the company's position in its industry and assessing its competitive advantages is crucial. Look at things like the company's market share, customer base, and any barriers to entry that may protect its market position. You can also look at the company's competitors to see how they compare in terms of financial health, valuation, and growth prospects. 9. Review analyst reports. Analysts who cover the stock may offer insights into the company's prospects. Look at the consensus target price, which is the average price target from multiple analysts. This can give you an idea of the company's potential upside. 10. Check insider trading activity. Insiders are people who work for the company and may have insights into its prospects. Look at whether insiders are buying or selling stock. Insider buying can be a positive sign, as it suggests that insiders have confidence in the company's prospects. 11. Look at macroeconomic factors. Macroeconomic factors like interest rates, inflation, and political instability can impact the company's performance. It's important to consider these factors when making investment decisions. For example, a company that operates in a sector that is sensitive to interest rates may be impacted by changes in interest rates. 12. Consider the company's dividend history. If you're looking for income from your investments, consider stocks that pay dividends. Look at the company's dividend history, including the amount of the dividend, how often it's paid, and any changes in the dividend over time. You can also compare the company's dividend yield to other stocks in its industry to determine whether it's a good investment. 13. Assess the company's debt levels. Companies with high levels of debt may be riskier investments, as they may struggle to pay off their debt if economic conditions worsen. Look at the company's debt-to-equity ratio and interest coverage ratio to assess its debt levels. A company with a high debt-to-equity ratio may be riskier than a lower one. 14. Look at technical indicators. Technical analysis involves looking at charts and other data to identify patterns and trends in a stock's price movements. Technical indicators can help you identify potential entry and exit points for a stock. Some popular technical indicators include moving averages, relative strength index, RSI, and Bollinger Bands. 15. Stay up to date. The stock market is constantly changing, so it's important to stay up to date on your investments. Follow financial news, read company reports, and pay attention to any changes in the company's industry or the broader market. This will help you make informed investment decisions and adjust your portfolio as needed. A diversified portfolio is a collection of different types of investments that are designed to reduce the overall risk of an investment portfolio. This means investing in a mix of stocks, bonds, and other securities, rather than putting all your money into one type of investment. The idea behind diversification is that by investing in a variety of different assets, you can spread your risk and reduce the impact of any one investment on your overall portfolio. The benefit of a diversified portfolio is that it can help protect your investments from losses in any one area. For example, if the stock market experiences a downturn, your portfolio may still be protected by the other types of investments you've made. Diversification can also help you take advantage of different market conditions. For example, when interest rates are low, bonds may offer better returns than stocks. There are many ways to create a diversified portfolio, and the best approach will depend on your individual goals and risk tolerance. Some common strategies for diversification include asset allocation. This involves dividing your investments among different asset classes, such as stocks, bonds, and cash. Sector diversification. This involves investing in a variety of industries, such as technology, healthcare, and energy. Geographic diversification. This involves investing in stocks and bonds from different countries and regions around the world. Investment style diversification. This involves investing in both growth and value stocks, as well as small cap and large cap stocks. Time diversification. This involves investing over a long period to spread out risk and take advantage of compound interest. By diversifying your portfolio, you can reduce your overall risk and potentially improve your returns. However, it's important to remember that diversification does not guarantee a profit or protect against losses. It's still important to do your research, invest wisely, and monitor your portfolio regularly. Thanks for watching. Don't forget to like, share, and subscribe to learn more.